A farm labourer's 26 property portfolio. Let's have a look. Hello everyone, Florian Heise here, and welcome to another episode of Heise Says. Grab your stein of coffee. We're going to look at a realestate.com.au article originally from the Daily Telegraph. And for once, it's not a Macca's worker that has got a multi-million-dollar property portfolio. It is a farm labourer, or at least that's how they paint it. Now, these are interesting for a few reasons, because, well, it highlights the fact that the messaging in the media, and obviously that realestate.com is very biased, is that the way to get ahead, to build wealth, and to be standing, I think, is that Japan? And in, skiing, on a snowboard, enjoying life, is property. It's the messaging we get here in Australia. You'd have to agree. Every time we see it in the media, everywhere, even on my channel when I look at these articles, it's the same messaging. Property is the only way to get ahead. Now, my concern is that diverts talent, effort, investment away from other industries. He's got, this gentleman, he's obviously talented and hardworking, so he's diverted his time and energies into property other than starting another business or doing something else. And, good on him. Good on him. He's achieved, he's working hard, and he's reaping the benefits of it. Nothing against him. But we need to take a step back and think bigger picture, the implications this is going to have on Australia for the long term, because, there doesn't seem to be much concern with that in the media. So let's start off by just refreshing ourselves, housing affordability. And if we have a look here, we can see Sydney houses that have gone up 565% since 1990 to 2020. Apartments have gone up 430%. Everything's gone up. Wages, they haven't quite gone up as much, and we'll look at that in a moment. But you can see this house price growth is consistent around the Western world. I feel sorry for the Kiwis. Some of the things that the government there is having to implement to try and deal with their housing growth is just insane over there. Gone are the days when you could work here and get a lot of extra bang for your buck over in NZ. So if we have, come on, what are you doing? There we go. So this is showing you the average weekly earnings from 1990 to 2020. Remember, we were looking at houses over 500%. There you go. Earnings has only gone up 320. Now, the government has come to the rescue, everyone, again and again and again for the property market. So we will remember, earlier in the year, we were looking at the article after article which was predicting property going down 10%, 5%, 20%, 30%, RBA modelling a potential 40% fall. The more I think about it, the more I suspect that was done with intention to nudge our politicians to intervene and prop up property. Maybe that's just a tinfoil hat moment here. What do you reckon? Do I need to have a shot of coffee? But we've got a cash rate that's pretty much nothing. 3% used to be the emergency, guys. 3%. I'm just changing my pen here so we can draw on this. You've got Home Builder, which is juicing up the building approvals. You've got grants at the wazoo. 5 and 2% deposit loans. Government guaranteed for the rest. 2%, everyone. 2%. I probably spent more than that on a graphics card. On my 2 graphics cards. Negative gearing, which is just long-term. It's pushing people into property. It is really pushing people into property more than anything else, because you can leverage. Banks will lend you a lot more money to go on a property. It's a lot easier to get a loan to buy a house than it is to get a loan to start a business. Then we had the super withdrawals last year. Some of it I would bet a carton worked its way into home deposits. So let's have a look at before we look at that, let's not forget the not in my backyard crowd, which is limiting development. The mortgage holidays, remember that. So what's going to happen the next time we have tough economic times? There'll be calls for mortgage holidays and there'll be calls for rampant stimulus. We've got trillions of debt now. Everyone, I'll bring up the chart. I need to bring this one into the slide deck so it's easier to find, but I'll look for it down here. We have significant debt now. Nothing has come for free. All of this government intervention, all of this spending that the government has done, what is it? 1.298 trillion by 23-24. So there'll be calls just to do the same thing again. Next recession we have. If in 20 years' time, 30 years' time, hopefully, or maybe in 5 years' time, there will be calls once again to intervene in the market. So let's have a look at this property portfolio for this young gentleman. So a farm labourer who dropped out of school uses cunning strategy. Cunning strategy. Are we watching Blackadder now? I've got a cunning plan to buy 26 properties worth $9.5 million. Okay, well, let's see. A high school dropout turned real estate investor, Sam Gordon, owns so many properties he often needs a minute or two to remember exactly where they are. At 31, the Southern Highlands native owns an impressive 26 properties spread across 4 states, or 4 capitals, including Brisbane, Perth, Adelaide, and Greater Sydney. These properties have a combined value of $9.5 million and generate nearly $540,000 a year in gross rental income, about $200,000 of which he pockets after paying his mortgage bills and other holding costs. Banks own $5.5 million of investments, with Mr. Gordon revealing he holds about $4 million in equity. So there you go. So it's half the bank, half him. So at least it's good that they're highlighting the fact that he's borrowing a lot of money to do this. He's taking on risk. So, I mean, that's the first time I recall seeing actual mention of how much he's had to borrow to do it. So good on you, Gordon. Good on the author who wrote this. Who wrote this one? Aiden. Good on you for highlighting that. Because that's the reality of this. For people to do this, he's using the equity from one to the other to keep investing. And in a rising market, that's a successful strategy. But we also have an interventionist government that will prop up the housing market. So it's a financial position that's all the more incredible considering he purchased his first property as a teenager earning about $35,000 a year from a job at his family farm in the New South Wales Southern Highlands. At 19 years old. What are you doing, guys? He'd been working since the age of 16 after dropping out of school midway through year 11. I was essentially a labourer, he said. It wasn't a high income. He used savings from the job to purchase his first property in 2009, a 2-bedroom unit in Wollongong for $275,000. There wasn't a huge strategy to it, he said. It was just a unit for myself to live in, which I could renovate. I got a good price. The renovation, much of which he did himself, and here's the kicker, helped increase the value of the unit. By 2012, he held a sizable amount of equity. So he did it up himself. He renovated it, added value to a property, and rode the market up. He did the work. He did the hard work. So it was at this point that he began to get more serious about his investing and started fine-tuning his purchasing strategy. So I wonder if he lived at home in that unit or not. But there you go. You suddenly see, wait a minute. Look how much equity I made. Look how much money I've made doing nothing or doing up the house, which he probably was going to do anyway, just to make it snazzy. For when he's bringing a girl home, you want it to look good to show off. I did a lot of reading, he said. The strategy was to buy under market value and have the chance to manufacture equity or cash flow. This meant looking for properties to his Wollongong unit, houses priced below comparable properties, and offering scope for improvement through renovation. The rents also needed to be high relative to the purchase price so that the mortgage repayments did not eat up his income. There will always be people who need to sell in a hurry and for whatever reason will accept a lower price if that means they can get the property off their hands quickly. If you have a good relationship with agents, you can find them. With this strategy in mind, his next property was a block in the Southern Highland town of Moss Vale, which he purchased for about $135,000 and improved with a renovation. So there you go. This before he bought it. I mean, look what he did here, before and after. So what did he do? He painted it. Got rid of the crappy air conditioning. Changed the kitchen. Put new changed the tapware. Looks like he kept the top of that. Yeah, it looks like he did. Changed the splashback. Kept the stove. He didn't do much. Got rid of the crappy thing here. Put a new vinyl flooring on. Plank flooring down. Probably all of that you could do yourself. You can even replace the taps yourself. I mean, that just shows you how easy it is to really jazz it up. It's a lot of it's the colour. The brown is what's making it look terrible. Really, we did the same thing on my mother's little unit down the Gold Coast she bought. We got vinyl plank flooring and put it in. Looked much nicer. Made a world. I love this stuff. I know it's not. As an architect, I'm meant to be all about the traditional materials and the real stuff. But as a parent, you want this vinyl stuff. If it scratches, you take it off, throw it away, put it down. It's soft. You can put it on concrete. You can put it on anything. Anyway, he used about 22 grand of the equity in his Wollongong property by refinancing the loan to fund the deposit. He's riding the equity train up. I'd manufactured equity in my unit, so the bank was happy to lend, he said. I got the Moss Vale block at a great price. At the time, the Sydney market was not moving. There was a lot of stale listings, so I negotiated on heaps of stuff. I went into the deal already having a margin and added value. He used a variation of this strategy for most of his subsequent purchases, including 11 properties in Adelaide, 7 in Brisbane, 3 in Perth, and additional properties in the Southern Highlands. Each successful purchase was used to leverage into the next. When you manufacture equity and the cash flow is high, it's easy to keep getting loans, he said. By 28, Mr. Gordon owned 18 properties and had enough passive income from his rents to quit his job. He then travelled the world for a few months while deciding what to do next. He eventually established, a buyer's agency based in Wollongong known as Australian Property Scout and has worked as a real estate professional since. I mean, of course, that's the smart strategy. I even see it with YouTubers. They'll leverage into a course or into another service that they provide. You see it with all the Amazon people. It's the education. It's another stream. Education is a huge market, everyone. It really is. So he said anyone could replicate his success. The key is do your research. You need to learn about the market really well and ascertain the value of what you want to buy. Most inexperienced buyers rush their decisions. They push really hard and go all out without doing their due diligence. They often pay too much because they didn't understand what the property was worth. Mr. Gordon said overpaying was common in instances where the buyer had originally been searching in a more expensive market and after being outpriced moved to a new location. They pay the same price not realizing how much cheaper the next market is, he said. Mr. Gordon added that agents tend to employ a common bluff by claiming they have received additional offers on properties when there were none. It could be a ghost contract, he said. Careful what you offer. Make sure it is based on comparable sales, not what the agent wants. You have to stick to your guns. If you put the offer in writing, then the agent under law has to submit it. That's often forgotten. Mr. Gordon also attributed his success to being prepared to invest interstate. Many of his best buys were in Adelaide, a market often overlooked by investors on the eastern seaboard. These markets have since become a lot more popular, and the rises in local prices have given him more equity. Sam's strategy. So let's have a look. Buying properties with high rents relative to the mortgage costs to keep the cash flow high and out-of-pocket expenses low. Buying under market value. Considering properties where there is scope to add value. Manufacturing equity. Using each purchase to leverage into the next. To refinance and draw out the manufactured equity as a deposit. So he's riding... this strategy works fantastically in a growing market. And he's had to work to do it, guys. Seriously. Hopefully now he's at a point now where he's not doing the work himself, but I don't know. You'd want to enjoy it. That's rewarding getting to that, but it can be a bit frustrating. It may just be easier to pay someone else to do it. We'll see. Depends how cheap it is. Only use 20% deposits to ensure the banks will issue the loan. It also gives more of a safety net for interest rate rises. Approach second and third tier lenders who generally have a higher risk appetite and are more likely to issue loans when you already have other commitments, and buy interstate. So there we have it, everyone. The secrets of a farm labourer turned property mogul. What do you reckon? What do you think? Good on him for doing it. But it also shows you, maybe that talent could have been deployed to another business. So what's the lessons? What's the takeaway here? Well, I think the biggest one is to buy cheap and renovate, everyone. And he worked hard. It's not easy. Anyway, thanks for watching. Let me know your thoughts and opinions on this one in the comments down below. At least it's not a Macca's worker for once. Good to see. As always, if you're a fan and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. You can support us using SelfWealth or Stake. Use our affiliate links at Amazon, eBay, Independent Reserve, or AussieBroadband. Buy our merch from HeiseSays. Use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day. I'll see you in the next video. Bye for now.